Happy Monday, everyone. Good morning. Welcome back, team, in this weekly macro update. This is going to be a good week again. Lots of things happening. And we're going to go today through like some macro catalysts and what to watch for the week. But take it away, Tim.
Yes. Hello and welcome on this Monday, folks. Let's jump right into it without talking that much around. As usually in our structuring here, we're having a quick review about the last week, what happened, and then we go into this week, what happens from the data side, what to expect. Today I also brought some commodity stuff into the presentation. We talk a little bit about the bond market, and we try to keep it crisp and fresh, that I don't have to talk that much for over an hour. And let's begin with last week. This time we are looking into a SPX chart here from the last week. The last week has opened in the US with futures and the cash session way more down. That's beginning here from the left. On new tariff stuff that came out of China, sends indices a little bit lower. If you guys have listened to the presentation from last week, I mentioned it with uncertain developments, right? So that's still a thing that can rattle up markets a little bit. We will see it later in the presentation. Why this causes that much of movement in price, why you have prices moving beyond the one-day min-max, so-called standard deviations, always calculated daily from the last price close in our company. That's usually pretty significant because those levels are watched in the industry as well. But let's get into it. I've mentioned the Monday here. Yes, on the left side, this dip got bought pretty well, as you can see. Last week was obviously a week of a lot of labor data. We had the JOLTS data on Tuesday, caused not that much of trouble. They were lower. That means you have less people vacant for jobs that they are able to work. Moving into Wednesday, ISM service numbers. I have mentioned this a little bit earlier last week. Those surveys from the Institute of Supply Management are pretty significant for the US because they can tell you a little bit how different sectors in the US are ongoing. Are they doing bad? Are they doing good? And much people are focusing here on prices because they have some impact of inflation. And because we have this week's inflation numbers, it was a really data point that much of people are looking into it. They came in a little bit lower. So rate cut expectations on Wednesday get bought a little bit. Heading into Thursday, it gets a little bit more interesting, as you can see on the chart. The little drawing that I made here is some kind of a feedback loop because we are seeing always the same stuff in markets, which were more significant on Thursday. Later in the cash session, we had some tariff news from Donald Trump. Sets the indices a little bit lower intraday with a rapid movement. You can see that's a 5-minute chart, right? So in the red rectangle here, this move was nearly twice as big as the move that you had from the start of the 9:30 cash session. The next slide will show you why this happened on this big extent. It got bought then later, and after hours Thursday, we had some earnings for Amazon, I guess. They were pretty good. So direct the indices a little bit higher after the close. But then Friday hits the tape, and Friday was a big of a chaos. Have it at least 8:30 we had NFPs. The NFPs were lower. and there was no big reaction from indices, right? I have mentioned this in the community, how the numbers should come out and what can cause movements over there. It proved the thesis to some extent because the number was in line. It was so-called sweet spot, and there was no big movement. But then it was 10 o'clock, and 10 o'clock, the University of Michigan numbers came out. That's a survey done by telephone, if I am informed right, asking about 500 persons and also small company owners what they expect from the economy, what they expect from inflation, and what they see in the current environment in the United States. Yeah, how stuff is going on. It's basically me ringing the phone and talking to you about these questions. How are your vibes with the economy? It turns out people are a little bit afraid of inflation expectations, which gives us a pretty significant down move, 10 a.m. And then we got two nice tape bombs, as they called, due to tariffs, sends us lower to the day, beyond the 1 day expected move to the downside. And we ended up on a level in SPX that we have seen on Wednesday, right? So long story short, not that much movement, but if a story hits the tape, which causes uncertain developments, the indices will find a way, and it was to the downside this week. And that's something that the markets keep busy, say it like that. That's the reason why I draw this little arrow thingy over here. It's always this little feedback loop. We are going from tariff news. No one knows exactly how they will plan out. So we get a little bit of downside. After that, they get bought again. And that's, always this little feedback loop. So that's the week ahead. Monday today, there's not that much stuff going on for the US, so we skipped that. On Tuesday, Jerome Powell will have a testimony in front of the Congress. It's usually a 2-day event, goes like 2.5, 3 hours sometimes, and that's scheduled all the time. So that's nothing really new. He does it twice a year, I guess. But of course, because he gets also questions to monetary policy and also to the economy, it can get a little bit choppy in the indices, right? So maybe try to avoid, if you are a day trader, have exposure here in indices. On the next slide, we will see why, because liquidity, okay? Wednesday, big day for inflation numbers. We'll come later to that. Thursday, as usually after CPI, the PPI comes out, the CPI for the producers, call it like that. And on Friday, retail sales. The earnings session is nothing special in this week, at least for me, because I always just watch the big and important companies that can drive whole sectors like semiconductors or big discretionary parts of the market like Amazon does. I think the most important stock Nvidia will report in 2 weeks, I guess. That's something we should watch, but for this week, it's nothing special, right? Of course, bigger earnings are reported from McDonald's today, I guess. And also later in the week, some stocks, but that's usually not stuff that can move whole indices. And that's the reason I write down there, nothing special for me. On the right-hand side, I have added some inflation swaps from 1 year to 20, 30 years. That's a big thing for Wednesday. They are actually ticking up a little bit. Much of this is related to the recent tariff talks in the US, because people don't have an exact idea how this will play out. Okay, So from this side, there's a lot of uncertainty in the market, but the main takeaway here is inflation swaps are already a little bit higher. So no one should be surprised if core inflation rate will come out a little bit higher. I think that's something the market can digest this week. So, and also on Wednesday, there's a second round of Jerome Powell with his testimony before the Congress. So Wednesday could be a little bit choppy and maybe has some surprises for us. So if you are watching or have watched a chart last week's, you may be surprised why we had this rapid moves to the downside, to the upside. And liquidity should be nothing new to you if you are trading markets. Liquidity can vary to decent high amounts and decent low amounts. The left-hand side chart over here is from the CME website, and it shows the ES future so-called top of book depth. The top of book depth is measured by bid versus ask, so it just takes in consideration market orders of the market, how much is needed to move the market. And with this chart, you can always map out some areas in the market where stuff actually happens. And I always compare it to these to have a better view where we are now. And that's the reason why I plotted this chart from July last year to January, so to last week Friday close. And this little valleys and the little peaks over there can usually always map against stuff that happens in the market, right? That's the reason why I added dollar-yen volatility that we have seen on August with the surprise rate hike from the BOJ caused a significant drawdown in liquidity, so markets can move wider, okay? You have breaches of 1 standard deviations down to the upside. Those charts are not meaning that we have risk off or something like that, right? Low liquidity works on both sides to the market, to the downside and to the upside. And we have seen an improvement into the elections. That's November 7th, 6th. Yeah, you can see the top of book depth is expanding over there. But now, and that's the arrow on the right where nothing is marked, we are hovering in a little bit low area again. This is mainly due to the fact that the current policy in the US with all the talkings from the president and all the talkings about tariffs causes this uncertainty. And it's also visible with options data if we are using GEX as some sort of liquidity measuring. Because if you're in the community and if you are trading the GEX levels that we are provide in the futures, they have more significance if you have a really, really high GEX into the market, and they have a little bit less of importance if there is a low one. So if you look at the dates over here, during the middle of January, that's 1 week before OPEX, you had a significant high GEX amount, 908 million total exposure. And now, I know we have 2 weeks until next OPEX, but it won't increase that significantly. We have more GEX into the market. There's also a breakdown with the dates below. And if you compare these numbers, like on the 13th of January, 66 million negative GEX, and today is like 49 million. It does not seem that much of a difference, 66, 49, but if you put it in percentage, it's actually a third less, and that's pretty big, okay? So that's the reason behind it. If something hits the tape intraday, a comment from the president or something else, you have these big movements. So if you are an intraday trader, less risk, a little bit of positioning size should be not really increased. I lean more to decreasing. I do the same, obviously, if I trade intraday. Not like a year ago with 4 or 5 contracts in ES. Now I stick to 1 or 2. That's always important because you have always managed your risk a little bit. And a little bit of extras in commodities. There's a big chaos over there because of the tariffs. I have mentioned it. Also, the commodity market isn't that aware of what will really happen. I usually write these slides Sunday in the evening, and as I wrote this yesterday, already new stuff hits the market with tariffs on aluminum and on steel, and it's really hard to keep this in place. But this week there was some kind of outliner, which is copper, and I have not seen that much people speaking about it, where there is this big trend, because if we are looking at charts at the next slides, it's really obvious that something is going on. In terms of tariffs for the US and copper, it's kind of a big deal, because the little prompt below says it already, that the US exports 30% of scrap metal copper, which is not refined or mined copper. It's scrap metal, right, from every electric devices that you can imagine. They get shipped to China, 40%. And also, we have a look a little bit of the dollar performance if we are talking about commodities, because if you are planning to buy commodities at a extent point or at an extent date into the market, usually big producers do it with swaps paid in dollars. And if the dollar is lower, you logically get more for your money and commodities should rise. But let's look into it a little bit. That's a daily copper chart from the current most liquid contract, which is the March 25 one. And last year, during November, we already had this little squeeze. And if you look at your copper chart now in the morning, it's opening kind of in the same range over there. And the thing is, last year, this little squeeze up here on the left-hand side was more mechanical. The thing behind is, if there's a squeeze in commodities, it should be supported by supply and demand, right? Because those price movements can also reflect some sorts of hedging and also some sorts of momentum. Always keep in mind, in markets, it's not always supply and demand. In commodities, you also have CTAs, trend followers, that are just buying the futures contract because it's going up or because it's going down. Best example was oil in the first week this year with this giant squeeze up to $78. And we have to find out if copper does the same now, or if this movement is fundamentally backed. Let's keep it like that. And very interesting, in the middle pane, those are dollar futures. They are basically flat. So we can't rule out the fact that this current copper squeeze is due to dollar weakness, because we don't have dollar weakness, okay? Positioning in copper, we are looking from left to the right. On the left side, there's a total net gag exposure for all the copper contracts that we have in our data sets. And there's gamma building up to 470, 75. We closed on Friday pretty close to 460. So there's potentially room to the upside for like 200 ticks. And this is momentum. And the most dangerous thing with momentum is, if you're trying to fake this for a counter trend, it's very unlikely your trend happens or works at the first attempt, because you can easily get overrun by momentum, right? If we are looking further out, which is on the right-hand side, the upper pane, those contracts will expire on the 25th of February. That's the left one. Shows us a little bit of the same picture, like the net gags overall with all expirations. And it's still skewed to the upside, as you can see. We are trading in positive gamma over here, significant strikes that you should use for your trade to map out the direction. And the next contract that is expiring is middle of the month, the 14th. That is this week, Friday. There's not much going on over there, just one big strike, but 460 round numbers. Commodities love round numbers. 460. If we get a foothold above there, it should fuel the uptrend a little bit more. And the lower pane is from the CME Quick Strike tool. It shows us implied volatility. They're using a little bit of a different measurement. I think CME takes in consideration all options that are trading on the future contracts. And as you can see over there, the implied volatility isn't that high. So there's not much of a chasing in prices, because usually if spot prices are going up and the IV also increases with them, options are getting a little bit more expensive, right? And people are chasing those trends, and usually price have to increase as well. But here we have just the price increase, and the IV is still pretty flat. Also, I have put in a skew here with the lilac line. It's still positive. As you can see, that's the left scale here from 0 to 12. It's still positive, but it doesn't look overbought. So my idea from Sunday was, because I made this on Sunday, you should see a little bit more on the upside here. And let's see if I can present it. No, I will do it later, just get over it a little bit. Because I have just a few slides today, because there's not that much going on. So I will present my screen later. Bond market, I have mentioned a little bit earlier. The yield curve over here, 2/10, that's a bull flattening right now, all right? Means, more simple said, long ends falling faster than the short ones. Yeah, why is it like that? Because the bond market always plays different stories. The short end moves to other stuff than the long end. Important note over here, the correlation for risk assets is still a pretty lowish, because sometimes you have times in the market where the people say, oh no, 10-year yields, they are up, I don't know, to 5%. That's a problem for stocks. We don't see this too much right now, but that's something we should watch in the future. Why? It's, say below. The 10-year yield is just shy below the effective federal funds rate. Why is it important? Because the effective federal funds rate is the rate into the market, as the name say, from the Federal Reserve, representing rates all the time. And if 2 years trading above this level, that's sometimes initiates a counter trend for bonds for the short end. So yields will come down a little bit, because it's very, very unusual that the 2-year yield is trading above the effective federal funds rate. I mean, it can happen. The bond market is, playing a little bit of a different story than equities. If you watch media, or if you are following some of the bond guys in social media, most of them are bearish. I would say the same to a certain point in the market. Because debt ceiling, bond issuance numbers, nothing has much changed, despite we have a new Secretary of Treasury with Scott Bessent. And yeah, the bond market is, let's say it like that, maybe drizzling down a little bit more. That's why the question over there says more downside. I would say yes, but we have to map this, of course, with developments like in inflation expectations, also rate cut expectations. And that's the reason why the little chart left low shows United States, Michigan 1-year inflation expectations. That's the number we have spoke about in the first slide, which came out on Monday, 10 a.m. And the chart is expressed in rate of change, not in nominal numbers. And as you can see, this rate of change is pretty big, right? It's the biggest since September of 2024. And if you are digging into this a little bit deeper, that's mostly driven by what? Of course, tariffs, because no one has a clue how this stuff will play out. How tariffs, like the 10% on China with some commodities like copper, steel, all the stuff will play out. And the problem is there is not that much of a model in the market that can show you if copper prices have a tariff of 10 or 15 or 20%, how this will change the copper market and how does it will affect the customer at the end. Okay, so this survey from the United States of Michigan, if they call the people and they ask them, hey, what's your take about inflation? They usually will say, uncertain developments. Yeah, right. That could be a problem. And I think that was the main reason behind it. We have this outliner in those numbers because inflation baskets, which I will check on Wednesday for the community, how the numbers are, they are showing some falling in some stuff like shelter or insurance numbers. So it's called like that. Friday 10 a.m. was a huge bullshit move from my view. And why we had those downside because of liquidity. We have spoken about it like 10 minutes ago. But it's always important to not looking just at fundamentals into the market. You also have to take into account the technical stuff, and liquidity is definitely technical stuff, right? Last asset for the day is FX, forex. And that's pretty amazing. I have 3 charts here. The upper one has a time frame since the election outcome last year, which was November. Then in the middle, there's a 1 month to date chart, and the last one is a weekly to date chart. And yeah, there's actually one currency that outperforms since then, pretty stable, pretty good trend, which is the yen. So this is, of course, technical, yes, but if we are talking about tariffs and if we have a president that says, tariffs for Japan are also likely to hit the tape, but then we have also a president that meets with some politicians from Japan and announces trade deals over there, there should be some interesting stuff going on, at least in the yen. And if you are an FX trader, no matter if you are trading the future, the 6J, which is always mapped against the dollar, as you know, or if you are maybe from Europe and you have the chance to trade CFDs and map the yen against the Aussie dollar, or let's say the euro dollar. no, euro dollar, something different, sorry, against the euro. You always want to see what is the strongest pair and what is the weakest pair. And the yen has proven some good performance since the last 2 months. We also have data on the dashboard, of course, for the yen. And yeah, that's the reason why I just added a little screenshot over there from the NetGex expiration for all 6J contracts that we are mapping out. Still skewed to the upside. Today we have a little bit of downside in the 6J. Yeah, 0.3% down, trading at the lows from Friday during the NFP print. Yeah, that's something I watch. I have a long yen position still open. That's a little bit in the green right now. But let me try to present my charts real quick. So what we had copper. All right, let's look into it. So yesterday in the evening, we have looked over copper a little bit. I hope it's visible, guys. So those are the actual GAX levels from today for copper, okay? Let's keep in mind, we were bullish since the open yesterday, Sunday evening. And yeah, we traded off HVL 0DTE for 60. That's also the strike I mentioned in the presentation. If we gain a foothold over there, should be more bullish. Already trading above the 1D max level, which is also call resistance at 465. That's, yeah, for me now, because I'm start trading with the US Open, it's too late, obviously. But let's look at 4 hours. Yeah, we are trading up to this peak from September, which was this little squeeze. And it gets even more exciting if you see copper trading at the 475.50s. That's a squeeze from May last year, where there was this big supply and demand issue, where the LSE in London wasn't able to provide enough copper for the world. That's the reason we have seen the squeeze here in paper copper. Paper copper is futures, obviously. Yeah. So as you can see, it kind of works in the morning. Only problem is that this trend has emerged already since Sunday, since the open. So yeah, if you're trading commodities, let it come down a little bit. Also, copper is a commodity that can easily trade 2 or 3% during the day, even more in this environment. And the other thing I would show you live, I had a swing short in oil, which has already covered. And I'm not sure if I talked about oil last week. I do it on Twitter pretty frequently. And I have read on Friday PM. Yeah, it was PM. Or was it during lunchtime? I don't know. That hedge funds are already betting big positions in crude oil shorts. I don't know how the Bloomberg guys are mapping out that these guys are just only short in futures, because it's really complicated to have a view like that. But as you can see, we are already up 2%. So yeah, that's usually stuff in oil that can escalate pretty quickly. Yeah, I wouldn't bet on too much downside here in crude oil, to be honest. Positioning looks a little bit overextended. Also volatility, we have a big lack of OVX, which is, let's call it the VIX for oil. So yeah, I don't know if we get more downside over here. And that's always a problem with media. If they are putting out stories like that, it's sometimes maybe better to fade this stuff, okay? So yeah, guys, if you have some questions, put it in the comments. told you a quick session today because we have usually the same stories as the last 2 weeks if you're an equity trader. Last week I showed you what dispersion is in indices, give you the tickers to check it a little bit. And yeah, we are keeping it like that, I would say. There's a question from Rajinder. Any thoughts on liquid gas price in euro today, highest in 2 years? Yeah, I mean, I'm not that much in liquid gas. I don't know what prices are you looking. If you're looking at, is it the TTF in the euro region, I guess? The let me see. Yeah, TTF. How is it? Oh yeah, the problem with gas is always you have to gain a deep knowledge and insight about the storage facilities, how full they are or how low they are, right? And now the big problem, what I read like, I don't know, a week ago or something like that, storages are running low. And that's pretty normal then for commodity futures that they are gaining this momentum because there's a lot of hedging. Producers, also companies that are involved in transporting all the stuff, they are experiencing some price pressure over there, and it can run much far than now. But European stuff, be it commodities or stocks, that's not my market, I have to say. I traded a little bit of NG in the US. NG is also up 3%. But yeah, that's not a big movement, to be honest, right? So natural gas futures today can also do 7% on the day and minus 5% on the next day. So long story short, no big or no good idea that it's worth to share for liquid gas in the EU area. Yeah, you're welcome. No problem.
Yeah, let's see if we get more questions, Tim. If not, as always, thank you so much. This was crazy insight that is really similar to what like a research bank would provide on a weekly basis for their portfolio managers. So we hope you guys are using these insights, finding value from it, because we obviously Tim puts a lot of effort, which is awesome. Thank you very much for everything you do. And if you guys want to learn more about all our models, some of the charts that Tim showed you, all our gamma levels, you can find us at mentorq.com. Let's see if we get more questions. Not yet. And we are going to be back. So let me share what we're going to have today. So today we're going to have another live session in a couple of hours with Dan. We're going to go over some backtesting results of our swing trading model, and we're going to go over some option strategies. So if you guys want to join, it's right here. This session right here is going to be available on our YouTube channel and on X. Very exciting. And then we're going to be back with Tim next Monday again for our weekly macro research. And I think,
Yes.
Tim, we're working on some very nice guests. So let's see what we can do on that. But I think it's going to be fun.
Of course.
All right. Awesome, guys. Thank you, Tim. And if you don't have any questions, see you guys again next week, and see you guys on Discord as well.
Yes, then have a nice week from me. And yeah, keep it tight this week and focus on Wednesday if you are trading equities on a daily basis. Just keep it like that.
Sounds good. Have a good day, guys. Bye-bye.
Okay, bye-bye.